Good morning. I hope you're all very well. Eid Mubarak, and hope everyone is also enjoying school holidays. Today is April Fool's Day, but I must admit, it feels like every day for the last 4 months has been Fool's Day. Certainly, some of the things that I'm going to talk about today seem unbelievable, but they are unfortunately no joke. Starting with tomorrow. Tomorrow in the US is Liberation Day. It sounds fantastic, but unfortunately, the only thing that's going to be liberated is consumers' wallets, as Trump makes everybody in the US feel poorer through higher inflation. The good news for them, at least, is they are going to get some of that tax back in the form of lower taxes and lower indirect corporate taxes. Whereas in South Africa, we are also going to be liberated from our wallets, but unfortunately, we're getting nothing back. But I'll talk more about that and our budget later on. Let's start with the month of March. And what a month. So let's have a look at performers. Top for the month in rands was gold, up 8.6%. Now, as you all know, I've got gold completely wrong. I understand it's a hedge against uncertainty. It's a hedge against inflation. A lot of people are holding gold and Bitcoin and crypto against inflation. And I must admit, I certainly know that inflation is a farce. Pretty much everything in the world goes up more than inflation. Inflation is just a benchmark. Things go up more. But even the things that go up the most relative to inflation, which is your healthcare spend and education spend, those are generally up to double inflation. Gold's gone up 3 times inflation over the last decade. So yes, it's an inflation hedge, but why an inflation hedge should be giving you inflation plus 5, or in this case, inflation plus 10, but let's call real inflation double inflation. It's still giving you much higher than even the worst case scenario for healthcare expenses and education expenses. So I think that gold is looking a little bit bubble-like. But for those of you who've been long gold, well done. It's been a phenomenal performer, #1 for the month, up nearly 9% in March alone. Then in second place, which is also fantastic to see, is SA equities, up nearly 5% for the month. It's not often we get SA equities up when the rest of the world is down. But we had phenomenal returns from commodities this month. So it wasn't just gold. Copper is up 30% year to date, which has driven South African resources into a massive rally. Resources were up 33% year to date, and that drove up South African equities, along with Chinese tech, which continues to rally quite nicely. And so between Chinese tech and which drives Naspers and Tencent, and a very strong, robust resource rally, SA equities are up 5%. Worst performer was US equities. That's down on slowing US growth, concerns about the trade wars, and specifically US tech concerns. You can see there that the worst performers for the month, FANG down 11% and NASDAQ down 9%. Our underweight tech position continues to work well. We did also reduce our US exposure during the month. We sold out our consumer staples. Fortunately, we sold out at the beginning of March when they were actually up 10% year to date. They did fall quite a lot since we sold, but we rotated out of US consumer staples and into emerging markets just to take advantage of some of that narrowing growth differentials, which I'll talk also about more about later. And that's what kept EU buoyant at, well, flat, at least at 0.4% in rand terms, and China flat at 0.6% in rand terms, was all the fiscal spend that's being unleashed in those countries as those governments try to counter the negative effects that they're expecting ahead of tariffs. So some major movements from China and Europe in the month, and I'll be talking about that as well. Looking at top fund performance for the month, you can see there South African funds, the top 40 ITRIX ETF and the top 40 unit trust are both in top position, #1 and #2. The performance is slightly different, but as you know, that's a timing difference where the ITRIX funds close at 5 o'clock and are closed. Actually, NAV pricing is driven at US markets, whereas the unit trusts are 3 o'clock pricing. Japan squeezes in to #3 as up until now, it doesn't seem like Trump's going to put excessive tariffs on Japan, but we'll find out more tomorrow, Liberation Day. but for the moment anyway, Japan being quite defensive. In third place at 2.6%. China, as we know, on the back of Chinese tech and also all the domestic stimulus, up 2.6. And then Berkshire Hathaway, our only US fund in the top 5 over 1 month and over 12 months. And Berkshire Hathaway proving to be very defensive in the US fall. And that's for 2 reasons. One, it does have a very high cash allocation, nearly $350 billion of cash on balance sheet, but also a very low tech allocation. I mean, they've sold down Apple aggressively. I think they've sold down 80% of their Apple holding, and that's worked well for Berkshire Hathaway, just as it's worked well for our funds being underweight tech. Over the year, you can see they're mostly South Africa, our top 40 equities, and the enhanced all bond fund. So both equities and bonds doing very well in South Africa, and China, top of the pops, up 25%. That's the feeder fund, MSCI feeder, which is very overweight Chinese tech because those are the largest companies in China. So yeah, more diversified fund returns this month across various regions. But interestingly, although Europe has bounced very strongly this year to date, we haven't seen the Euro Stocks ETF in the top 5 in each of the individual months, but it has been holding up quite nicely. Okay, so let's get on to the theme for the month, which is US exceptionalism. Is it dead? No, it's not dead, but it certainly is fading a little bit. So we did see a huge collapse in the S&P 500 as well as the NASDAQ over the month of March and year to date. In fact, we've seen the worst quarter in the US relative to Europe since 2009. Now, 2009 was the great financial crisis, also called the subprime crisis. It was all about the US. It was all about their housing market being overpriced and collapsing, and it nearly destroyed the US. It's probably since the 1930s, one of the biggest balance sheet recessions the US has faced in the last century. And so you expected back then the US to underperform all of the markets. But Q1 2025, we've seen the same underperformance of US relative to Europe as we saw in 2009, which just talks to it being overdone. And the chart on the right there also shows how fast the US positions have unwound. So yes, I mean, US markets came under pressure because of trade and tariff wars, because of the slowing growth, and because of tech concerns. But it was also exacerbated by very narrow leadership and by crowded positioning, and that led to very fast unwinding of those positions, and that led to stop losses being triggered, which leads to forced sales and deleveraging. And we saw the fastest unwind of the momentum factor in 40 years. 2 years of gains in the long momentum factor in the US were unwound in 3 weeks. Just an incredibly fast moving market. Things just moving so fast everywhere. And that's down to that unwind is at the 95th percentile. So what does that mean? It means that a lot of the froth that was in the US has been unwound. It doesn't mean we're going to see a bounce anytime soon, but we shouldn't see things falling much further than they have due to the very rapid unwind. So let's talk about US exceptionalism more in the short to medium term. So one of the reasons why Europe rallied so strongly was because of the dramatic change in Germany's attitude towards debt, and I will talk about that in detail when we get to the EU section. But if you look at it in totality, so far Europe or the EU has outlined about 150 billion of defense spend that they want to spend. Alpine Macro estimates that the EU is probably going to spend $1 billion, sorry, $1 trillion, these numbers are just so huge, $1 trillion more than they had planned to a few months ago, of which half of that, 500 billion, is the German infrastructure fund, and the other 500 billion is likely to be defense spend. So that's $1 trillion over 10 to 12 years. Now let's look at the US. The US in the last 3 months, US companies, not the US government, US companies announced $1.8 trillion worth of onshoring CapEx commitments. Onshoring CapEx commitments that will be spent over the next 4 years. That's nearly double what the EU is going to spend in less than half the time. And that's on top of the already 45% increase in 2025 CapEx alone. That's for the big AI tech companies are going to spend. So Microsoft, Amazon, Google, and Meta have announced $329 billion in CapEx. Yes, it is one of the reasons that investors in those companies are concerned and why those prices have come off, because maybe they're spending too much. But when you're going to see over $2 trillion being spent over the next year to 4 years in the US, it does make you think that maybe the market's getting a bit too excited about possibly $1 trillion over the next 12 years in Europe. So yes, there's definitely been a convergence of the growth rates in the EU and the US, but the US growth is still well ahead of Europe. In fact, we had updates from all the experts in March. The OECD came out with their expectations for 2025 growth and 2026 growth. The Fed came out with their expectations of growth. ECB came out with their expectations of growth. And yes, everyone did marginally downgrade growth slightly, 20 to 30 basis points. Nothing too big, certainly nothing that forecast recession. And most interestingly, very similar impacts to the US and Europe. So they're not actually pricing in any narrowing of that US exceptionalism like markets have. I mean, markets have priced in a massive narrowing of that exceptionalism. More importantly, all those growth downgrades didn't forecast a recession, and the market certainly reacted in a similar way. Yes, S&P 500 was down 10% at one point, NASDAQ was down 13%, but Europe was up over that same period. China was up, Japan was up. As I said, commodities have had a really strong month with copper rallying to new highs. The dollar weakened. None of those things happen in a recession. So markets are saying, like all the economic experts are saying, don't have to worry about a recession just yet. And that's rather a specific issue that the US is facing that's causing this downturn. Now, I'm not saying that risks don't exist. Certainly risks are much higher than they were. And we've got a lot of strategists increasing the probability of a recession over the next 2 years from 10% up to 30% because of the uncertainty that Trump's policies are causing. But right now, we're not seeing confirmation of that because we don't know what Liberation Day is going to unwind. So everyone's waiting to see exactly what happens next year. I think the table at the bottom is very interesting. So I presented at Investment Forum last month, and it was all about forecasting asset class returns for the next 30 years. And when it comes to 30-year returns or even 10-year returns, it's not so much about valuation, it's about understanding what tailwinds are driving growth, because growth in developed markets certainly drives equity returns, and your impacts of inflation and economic growth also drive your bond return. So if you look at the table, some of the top 7 big tailwind drivers or headwind drivers are there. So the first is fiscal union. So when it comes to basically being a country, the US is a country, Japan is a country, China is a country, they can decide how they want to deal with growth very quickly. They can change monetary policy, they can change fiscal policy, they can implement banking laws very quickly. The EU, and the reason there's no blue dot in the EU sector is because the EU doesn't have a fiscal union. Each country is independent, and Germany sets its own debt targets. Italy sets its own debt targets. But it's not just that. The EU doesn't have a banking union either. So there's no way to harmonize banking regulations, which means it takes far longer for things to work through their system. So it's just one reason why the EU is less efficient, why growth is lower, and why it's slower to react to market events than other countries. Then we have private property. Certainly, developed markets like US, EU, and Japan have very strong private property laws, whereas China doesn't. China's trying to change that, but it's going to take a lot of time before people have faith in what China is trying to do. So I've left that block blank in China. Then AI. Certainly, we've all thought that the US was exceptional when it came to AI, and that they were the only leader. But certainly, over the last 2 months, China, and that's why there's a little new in that block, China has shown that it is certainly rallying really strongly in the AI sector and challenging the US for that leadership title for AI. And maybe they are even ahead of the US when it comes to AI. Deregulation, that's something Trump is doing really well, and it's something that we mustn't forget. When it comes to inflation concerns, yes, we've got issues like immigration in the US, but issues like tariffs. At the same time, Trump has completely unwound all the climate change, all the green regulations that Biden put in place, which were causing and costing a slowdown in productivity, a slowdown in growth, leading to increased inflation. I'm not saying it's a good thing to unwind all that policy, but it certainly removes a lot of red tape. And it's not just climate change. There's other deregulation that Trump has put in place, which certainly will help growth go faster. Whereas, the EU, as I said before, without a fiscal union and without banking unions, it's very difficult for them to enact any sort of deregulation. Japan has actually doing better in terms of trying to make their companies more efficient, but they're still riddled with cross holdings and a number of traditional structures which make Japan not as efficient as the US and China. They've got their own headwinds when it comes to the private sector just not being allowed to deregulate due to concerns like common prosperity. Now, it is interesting when common prosperity was something that Xi Jinping introduced a few years ago, and it completely destroyed Chinese stock markets, but it was all about making growth fairer. It wasn't about the stock market. Growth shouldn't just benefit the stock market and the wealthy. Growth should benefit the economy and create jobs, which is very much what Trump's trying to do now. I mean, Trump's trying to say, listen, it's not about the stock market. We've got to take short-term pain so that everyone can benefit in the long term. So when you look at it from that perspective, that's it is a concern for stock markets. But in the longer term, there's certainly at least there's a balance to that from the deregulation side. Then tariffs, negative for everybody. And demographics, I think, of a completely underpriced factor, but certainly one that drives GDP very, very strongly, and growth, which drives equity markets. So the oldest country is Japan. Let's quickly. Growth is made up of productivity and labor supply growth. So it's how many workers you have and how effective they are at working. Japan 30 years ago, their growth stopped being driven by population growth. So from 30 years ago, they had zero population growth. So any growth that came through in the GDP was purely from working smarter and harder, being more productive. There was no growth in the labor supply. EU crossed that period about 10 years ago. So for the last 10 years, their growth has been much lower because they only can rely on productivity growth, and they're struggling with productivity in the EU because of a lack of deregulation. China crossed that threshold a few years ago, and the US is likely to get there in about 5 years' time. But for now, the US is the only country that has a tailwind of strong labor supply growth. Part of that is definitely helped in the US by their very pro-immigration laws. And despite what Biden said, immigration has been very, very strong in the US. And there is a concern that if Trump turns that around, we will see slower growth and higher inflation. But that is something else to worry about. But if you look at the table in totality, you can see that the US over the long term definitely has double, if not triple, the tailwinds that the rest of the world has. But in the short term, certainly tech headwinds are a concern as a slowing growth and the tariff wars. So let's get on to the US and look at that in more detail.
Outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Thank you, Jeremy. So that is the Fed's view. They lowered growth marginally from 2.1% to 1.7% for 2025, but certainly not forecasting any recession this year, with the probabilities going from extremely low to slightly higher than that. Not only that, but despite inflation looking a bit stickier in the US, they're still forecasting 2 rate cuts. And that means that when you look at overall monetary policy in the US, it remains very, very easy. And easy monetary policy is very important because that helps growth carry on. And so it's important to note that monetary policy is easy and not tight in the US. So let's look broader. So what caused the downturn? As I said, it was three things. It was lower growth, it was tariff concerns, and tech weakness. So let's focus on the tech weakness because that certainly led the downturn, the NASDAQ down 13%. What are some of the concerns? Well, there are three big ones that markets are grappling with right now when it comes to tech. The first and the largest is the unsustainability of AI infrastructure spend. As I said, those top four companies are spending $329 billion in 2025 on capex alone. It's just a mind-boggling number. And it's up 45% year on year. It's just a huge increase. Warren Buffett always says that he doesn't pick companies. He's an allocator of capital, and he knows that companies reinvest their capital at the wrong time. And so what he does when it comes to his portfolio, the most value he can add is by stopping companies from investing at the top of a cycle and making sure they invest at the bottom of the cycle. And that's basically just seeing the forest for the trees or the trees for the forest. And that's certainly one of the concerns, that these tech companies are spending too much at the exact point in time when China is releasing a number of new models. It's not just the DeepSeek R1, but we've had Baidu's Ernie model, we've had Alibaba's new AI model, all of which are coming out at pricing points which are much cheaper than the US models. So it means, can those companies actually monetize their models, or are they going to be forced to sell them at a loss and not get the return on capital that they're spending? So that's one of the concerns that we've had for the last, 6 to 12 months, and why we've been underweight tech. There are some smaller concerns which are less certain, but certainly are risks. The potential semiconductor export bans. So we all know that Biden tried to reduce exports of chips to China to try and keep China's tech sector, from an AI sector in particular, from not competing with the US. That didn't work out. But Trump has said that he'd like to tighten and increase those export bans, which would mean that chip manufacturers like NVIDIA would not be able to sell as many chips as they currently do to China. So that would obviously reduce revenues for those chip companies, in particular NVIDIA, but all of them. And then Trump also wants to repeal the CHIPS Act, which is seeing a lot of domestic US infrastructure spend on chip manufacturing, which again, unwinding that could lead to a lot more uncertainty and certainly some price pullback in those shares. So definitely some concern in the tech space, but when it comes to the fact that the US has slowed, and the US has slowed very quickly in Q1 of 2025. The Atlanta GDP now forecast for Q1 GDP is negative nearly 2%. Now, firstly, you need to adjust that for some technical factors. And one of them is the fact that the US has imported so much gold over this quarter that it's actually, it's made those numbers look very distorted. So when you adjust for the huge gold imports, then Q1 growth is still low, but it goes from negative just to flat. And then when you further adjust for a very cold and unusually cold winter in the US, it goes from being flat to slightly positive. So yes, things have slowed, and a lot of that slowdown was again from a very strong fourth quarter of 2024 as people try to get ahead of tariffs. So yes, the US slowed, but some rather unusual factors which have to be adjusted for. When you adjust for all three factors, US growth is not as slow as everyone is concerned about. As I said, the Fed is only reducing that growth for 2025 to 1.7. Other forecasters think it's 1.9. So definitely not recessionary. So other things that support the fact that US growth, while slowing, will be relatively robust this year. Chart on the right just shows strong US retail sales above 3% for Q4 last year, which means there's a very strong buffer against a slowdown. Even if tariffs take off 1% from growth, you're moving from 3 to 2, you're not going down to 0. Some of the other factors, the labor market still looks robust and broad-based in terms of its sustainability. We're not seeing unemployment rise. Inflation in terms of core PCE was at its slowest pace in 4 months, which has allowed the Fed to continue to cut rates, which is good for easy monetary policy, which is good for growth. Then an interesting one, US Magnificent Seven valuations are down to a 3-year low since 2022 at a PE of 26, which is still relatively high compared to other companies, but compared to their own history, 26 is not too bad. Another point is that the dollar has weakened, and 40% of US S&P 500 revenues are globally based. If you think about it, we're all paying our monthly subscriptions to Amazon Prime and to Netflix, and so that as the dollar weakens, that gets translated into higher dollar revenues for those companies, and so even as growth slows, those earnings keep up with buoyed by the weaker dollar. Then a more nuanced one is EU's defense spending. So the EU is going to spend more over the next 10 to 12 years on defense. But right now, they don't have a huge capability. 90% of their spend on hardware has gone to the US since the start of the Ukraine-Russia war. And that's going to have to, yes, it'll come off, but it's going to take a while for Europe to build up its own production facilities. And so, that any spend is actually going to support or continue to support the US in the short term. We also saw US corporate insiders, the buy to sell ratio that rose from 0.31 to 0.46 from January to March. So the US CEOs are buying their shares, which means they're not too concerned at this point. But it doesn't mean there aren't risks. So yes, looking at all the data points, the US is slowing. We understand that while the market sold off, it probably sold off too much. Which is why we did reduce our US exposure. We took profits on consumer staples, but we are still holding on to our mid-cap position, our underweight tech mid-cap position, because even though that hasn't done well, we don't think the US is heading for recession. But there are risks, and no one will know what those risks are until Liberation Day tomorrow. And even tomorrow, we're unlikely to get, certainty, because the Trump's negotiation styles are going to continue for the next 4 years. But hopefully we get more certainty on tariffs. Now, the tariffs are certainly a risk. Now, we've got US consumer confidence at the lowest level in 4 years because of tariffs. We've got Michigan's year-ahead inflation expectations at the highest level in 30 years, and that year-on-year level has risen to 5%. So when it comes to tariffs and inflations, it is interesting to see what the market is doing. So while the consumer is very concerned, what's going to happen is, if you think about it, so if suddenly BMWs are 20% more expensive for Americans to buy, either BMW will cut their margins, which will be bad for European stock prices, or Americans will pay more for their cars, and that will only be people who can afford it, so it's unlikely to be broad-based. And more likely, the Americans will switch to a car that is lower quality, but the same price they were paying a year ago. And it'll probably be a combination. So EU stock prices will be hurt a little bit as their profitability is squeezed. US Ford may get more purchases because their cars are being bought more. Some people pay a little bit more, so inflation will go up, but a lot of people will just downgrade to a lower quality vehicle, which will support US earnings. So when it comes to inflation, it's a bit more nuanced than just tariffs lead to inflation. And what likely happens is a tariff just actually leads to less growth because there's less uncertainty. And certainly, despite it being less certainly not only is there less growth, but because of the uncertainty, the consumers just hold back a bit. And so I don't think the Fed is too concerned about the inflation expectations of consumers being at 5%, because consumers, as I said, they will either trade down or they'll just hold on and spend less. So if anything, the Fed might actually cut rates, not push up rates. But the Fed's going to be watching other indicators far more closely. Firstly, the markets. And if you look at the market's expectations for inflation, the 5-year forward starting 5-year inflation number, which is a very big one, very important one, that's sitting at 2.4%. So that's nothing to be too concerned about. So the markets aren't as concerned about inflation as the consumers, because the markets know that as growth slows, inflation will come off. Now, the other thing to look at is businesses. The businesses aren't as sanguine about inflation as the markets, but certainly they're not panicking like consumers. And they're seeing inflation a little bit higher than last year, but nowhere near as high as was during COVID. And that's also important because business expectations drive hiring, it drives investment, and while businesses aren't panicking, that also is something the Fed will be focusing quite closely. So I don't think while tariffs are causing a lot of uncertainty and a lot of volatility, and we'll see exactly what happens tomorrow, I don't think tariffs are too much of an inflation concern. They're more of a growth concern. What I am worried about, which could have a much bigger impact on inflation, is immigration. Now, hopefully, Trump doesn't do what he's told he's going to do about immigration. And so far, he hasn't. So far, I think about 30,000 people have been deported. But if Trump had to remove all undocumented workers from the US, it'd be about 5 million workers. And that would reduce GDP by about 1% per year over the next 4 years. Not only will it reduce GDP by a huge amount, and that's separate from tariffs, but it also put a huge increase on wages, particularly in the bottom quartile of that wage. So not only would you have falling growth, but the Fed would be forced to raise rates because of that inflation, and then you'd see a very nasty recession. So I'm much more worried about immigration. Hopefully Trump just does high-level visible things, deport 10 people on a very expensive plane and a helicopter, and make everyone film it so it's on TV and people think that's happening, or raise the wall, or do some smoke and mirrors. But if he gets aggressive about immigration, well, then we're going to see some very worrying things in the US. As I said last month, 70% of the jobs that were added last year in the US were all immigrants, 70%. So without that, growth would have collapsed, inflation would have spiked. So immigration is a big concern. Tariffs too, but the tariffs are more about growth, less about inflation. And we have to wait until tomorrow to Liberation Day to find out exactly what's going to happen. Okay. Moving on to Germany. So Germany was the big surprise, and I certainly was completely blindsided by this. I mean, Germany has been incredibly conservative when it comes to how much they can spend in terms of budget deficits, because they've been terrified about inflation for the last 80 years. Since Germany had hyperinflation, that the psyche of the collective psyche has been very concerned about inflation, and it's been enshrined in their constitution, their basic law, as they call it, not to be able to spend too much to avoid hyperinflation. So the change that happened was historic. There was a major shift and surprising for the traditional conservative economy. So I got it completely wrong. I really thought there was no way this could happen. The market's rallied hugely. I do think the market has overreacted for a number of reasons. So let's look at that in detail and why I feel the market has overreacted. So let's look at what this program includes. Firstly, it includes exempting defense spend from the debt brake. So the debt brake is this constitutional limit to borrowing, which said that basically the German economy had to have a balanced budget every year. They couldn't borrow just from a cash perspective, and that has been exempted from a defense perspective. Not only has defense been exempt, but they're establishing a separate off-books 500 billion euro infrastructure fund, which will be spent over the next 12 years to try and support growth. Now, looking at that from a monetary perspective, that should boost German GDP by 1.3% per year. That doesn't seem like a lot, but when you look at the baseline growth, which is 0, they've been going sideways. It's actually quite a lot. In fact, it's one of the few countries that have grown below South Africa. So when you're going from 0 to 1, yes, you do want to get excited. What are the broad implications for the EU? Somewhat. But because it's not all of EU, we're looking at about 35 basis points increase to EU GDP over the next per year over the next 10 years, which is definitely better than it was, but it's not a massive game changer. Why? Because there's still huge risks. First one is that Germany was able to make these changes, but the rest of the EU countries are already at their budget deficit limits. In fact, if you look at the second largest country, which is France, their budget deficit is sitting at 6%, which is double the EU limit. So they need to get their budget deficit down. They've got to start saving dramatically fast to try and get within those EU limits. And we all know what's happening there. And there's huge political uncertainty as they fight about. Macron's trying to get that budget deficit down. Le Pen is saying, or Le Pen was saying until she got arrested, that no, we need to spend more. But either way, there's a coalition government and a lot of uncertainty. So the rest of the EU is unlikely to be able to match what Germany's doing. Well, it can't match what Germany's doing. So this is limited to a change in Germany's spend. So it dilutes across Europe. Not only that, but Europe faces the same risks that every other country does, like Mexico, like Canada. It faces retaliatory tariffs tomorrow. And it's not just extra tariffs that the US is going to put in place, but Europe itself is going to retaliate. They're planning on retaliating on $28 billion worth of goods, which means that Europeans will face higher inflation because they're paying more for those goods. Europeans will have reduced consumer confidence. Europeans will start spending less. They'll limit rate cuts, and we'll have all the negative impacts that we're currently seeing happen in the US. And the rest of Europe doesn't have this fiscal spend that Germany is going to have to try and balance it out. Then we've got the structural 10 and 20-year headwinds that I spoke about. Europe doesn't have a banking union. Europe doesn't have a fiscal union. And Europe is a collection of individual countries. And Trump and Xi Jinping and Putin are all very well aware of that. And so they divide and conquer. They go to Italy and they go to Hungary and they do a sweet deal just for that country to try and work on their bilateral arrangement. And you end up with Europe just being completely split, divided, conquered, and you can't get this cohesion that you need to have a unified view to work against Trump or to work against China or to work against Russia, because you've got these separate ideologies, some right wing, some left wing, and you can't all work together and get the same view that Trump can put into effect on day one, or Xi Jinping can just say it's going to happen, or Putin can just announce. So that democracy works against Europe to a great extent. The other issue that's facing Germany in particular, but Europe as a whole, is falling productivity. So as I said, Europe is the second oldest population region after Japan. Their population stopped growing, the labor force stopped growing about 15 years ago. And so they're relying on productivity to grow. Now look at the chart on the right. That shows Germany's productivity relative to US productivity over the last 25 years. It's gone from 100 down to 76. So it's fallen by 1% a year, every year for the last 25 years. And that's just because Germany's productivity has fallen. And it is one of the impacts of an aging population is that populations that are aging face falling productivity. I don't know if it's because the causality is uncertain. Maybe it's just, as your most experienced people tend to retire. Maybe that's why the labor force is not as efficient. Maybe there are just other issues like having, a larger reliant tax base being driven by a smaller working force. And as those taxes get higher and higher, so people are less inclined to want to work. So it might be aging populations, it might be higher taxes because of the dependency ratio is higher, it might be because your skilled people are retiring, whatever it is, aging populations face these falling productivity levels. And so it's not just an infrastructure fund that's going to turn that around in Germany. We need to see supply side reforms. We need to see deregulation, and those are going to be much, much harder to achieve given the the fragmented state of the coalition governments and just the aging populations within Europe. So yes, when it comes to the US and Europe and Japan and China, certainly things are improving in Europe and certainly things are improving in China. No news really out of Japan. And certainly there's a lot more uncertainty in the US. So we're seeing some convergence of the growth between these countries, but it's a marginal convergence. And at this point, I'm not seeing the end of US exceptionalism at all, but certainly a lot of uncertainty in the US in the short term. Okay, let's move on to China quickly. As I said, people are concerned that all this uncertainty in the US, all this focusing on restructuring and rebalancing the economy at the expense of the economy and economic growth is a concern. And the fact that Trump seems to be talking more like Xi Jinping was about common prosperity 4 years ago than he is now. And in fact, the market's talking about the Xi Jinping put, as opposed to the Fed put. So right now, the market thinks that China is more capital friendly than Trump. So why? Well, there's just a lot of good news coming out of China. China has been plagued by two things. Firstly, it was the housing bust nearly 4 years ago, and that caused a massive decline in US GDP. Sorry, in Chinese GDP. But on top of that, 3 years ago, Xi Jinping's common prosperity wiped out the tech sector completely. Now the tech sector is starting to rebound, even though the housing sector is still muddling along, but we're seeing a lot of reforms coming through in the short term. So the National People's Congress has set a GDP growth forecast of 5%. And the OECD, the only country that they upgraded in their March estimates was China. So while the rest of the world has been downgraded negatively, even though it's marginal, China is being upgraded slightly. So that's good for China. But we're also seeing China's broad-based fiscal deficit is the highest it's been in 3 decades at 9%, 2% higher than last year. So China is throwing money at the problem to a big, big way. 9% is a massive budget deficit. They've also doubled the consumer subsidy scheme, that's basically the cash for clunkers scheme, and they're planning on extending it to include services. I don't know how you do cash for clunkers for services. Maybe you just write checks and sponsor holidays or you discount holidays, but they are doing whatever they can to try and drive domestic consumption because they know that they are going to struggle to rely on exports given what's happening with trade wars and tariffs. They furthermore announced a special action plan to enhance consumption, an entire plan designated to trying to drive domestic stimulus, domestic consumption, domestic confidence. Then we are seeing some good on-the-ground improvements in Chinese earnings. If you look on the chart on the right, that shows Chinese 12-month forward earnings divided by emerging market earnings. You can see there that they bottomed in August last year. And since then, for the last 6 months, we're seeing a very nice upward trend in Chinese earnings. And that is driven by liquidity injections at the local government levels, which have unblocked frozen payments in the property sector, which just means the whole economy is finally starting to work from a frozen perspective. It's almost to the same extent of when the Fed bailed out Lehman Brothers in 2008, or 2009, not quite the same, but we're finally seeing a frozen market starting to work when it comes to the property market in China, a four-year change, which is very important. Then, as I said, when we looked at the exceptionalism chart on the beginning, China has introduced the private economy promotion law. It's first a national level framework to protect private enterprises. It's been under development for quite some time now. I think it's going to take a while before people trust it because Xi Jinping can just change it overnight. But it's a step in the right direction. But most of the buying when it comes to foreign purchases of Chinese stocks has been in the tech sector, which has driven up MSCI China because it's heavily tech-based. And that's been driven by not only the DeepSeek R1 model, but as I said, Baidu launched their new AI model, Ernie X1. Alibaba's also unveiled their new AI model. And China is definitely showing that when it comes to large language models and generative AI, they are up there with the US. So a force to be reckoned with. And they not as concerned about monetizing as they are about research and development, which again is the reason why I think that the MSCI China stock market has probably rallied a little bit too hard in the short term. We did switch into some EM this month. And the reason we were comfortable to do that because it's broad EM. It's basically 1/5 China, 1/5 India, 1/5 Taiwan, and then Korea and the tail. But India is looking very attractive. It's off more than 20% from its peaks. And that means it's probably, while there are some headwinds to India, it's a good entry point there. So we're more comfortable, despite China being the best place to deal with reciprocal tariffs. MSCI China is really very hard on the back of tech. So it's the balanced portfolio with India allowing us to buy in at decent prices. So we're not buying China directly just yet. And if we were to buy China, we'd probably buy the A shares, which haven't rallied yet, and hold off on Chinese tech. Chinese tech, that, as I said last month, Chinese tech is still relatively cheap, but not as concerned about profitability as the US. So, I think structurally should be cheaper for a reason. Okay. Let's move on to South Africa. We've also got our Liberation Day tomorrow, where we're going to find out what's going to happen to the South African budget. Unfortunately, no matter what happens, SARS are going to be liberating us from our wallets, and we're not getting much in return, unfortunately. So a much worse outlook for us than in the US when it comes to the budget and the Liberation Day. Now, I was fortunate enough to attend a roundtable, a Q&A session with the Finance Minister and National Treasury last week on the budget, and it was incredibly exciting and incredibly disappointing. From an exciting perspective, it was just amazing to see how, on top of things, our Finance Minister, the Finance Department and National Treasury are when it comes to economic policy. They know exactly what needs to happen to drive growth, to reduce debt, to improve employment, and just to get our country out of a hole. They are on top of it, incredibly professional, incredibly impressive. So that was the exciting part. The depressing part was that this is probably the most disappointing budget I've ever seen. It is just, it's almost like the finance department has given up. They know what needs to happen, but when it comes to actually doing what needs to happen, they haven't been able to achieve the political will at the presidential level to get the spending cuts that they need. Not only that, but if they can't get the cuts they need, well, then try and get the cuts try and get spending to be more efficient. Because as I pointed out, the Auditor General has said there was nearly 30 billion rands in wasteful expenditure last year alone. But National Treasury has been unable to achieve that because of the lack of law enforcement. So they know what needs to be done, but they can't reduce spending because of a lack of political will, and they can't make spending get any returns on their spending because of a lack of law enforcement. And that lack of law enforcement is, I think, the most worrying factor. I also attended a conference a few weeks ago where Busi Mavuso, head of Business Leadership South Africa, spoke. She's an incredibly passionate and powerful speaker, and she was very concerned about the future. Very, very positive that things are moving in the right direction and that GNU is making a difference, but very concerned because she said that state capture is alive and well. And that talks to this lack of law enforcement. So, yes, National Treasury is amazing and the Finance Minister knows exactly what needs to happen, but we just don't have an ability to either make spending cuts like we need to, or get something out of the spending, get a return on our spending. And what we're seeing now as a result is a huge increase in spending. Spending in South Africa will rise to, government expenditure will rise to 32.4% of GDP this year. That is higher than every other emerging market. We are the tax revenue that is collected in South Africa divided by our GDP is higher than every other EM. What are we getting from that? Very little. If you look at the chart on the right, you can see there how the green line on the top panel shows government expenditure relative to GDP. And this chart is a couple of months old. So the green line goes up to 30%, where I just mentioned we have 32.5. But as the government spends more and more and more of our GDP, so inequality has got worse. That's the blue line, the Gini coefficient. And look at the bottom panel. The bottom panel is just depressing. It shows just a collapse in governance from a control of corruption perspective, a government effectiveness perspective, and a regulatory quality perspective. And this is all from the World Bank. So it just shows that the government is spending more and more and more. They're raising taxes more and more and more, and we're getting nothing out of that. So what National Treasury needs to do is cut back on the spending, or at least trying to get something out of that spending, but we're not. So what's happening is our debt levels are at very high levels. Our debt servicing costs are nearly triple the EM average. We're spending over R1 billion on interest every day. 22 cents in every rand of tax collected goes to interest. We're basically stuck in this debt trap. We've seen the budget deficit go from 4.5% to 5%. We've seen the peak in debt to GDP go from 75 to 76%. So while at the medium-term budget policy statement, things looked under control, in the last 6 months since then, National Treasury has added 233 billion rands worth of expenditure. Spending has just gotten out of control, and we can't afford it. But right now, it looks like there's nothing we can do about it. And that's very, very, very worrying. So how are we financing this cost? Well, we can't, and we can't afford it. We're really on the wrong side of the Laffer curve, as Professor Arun has pointed out in his webinar. So the last thing we should be doing is increasing personal income tax. One of the disappointing things about the GNU, and in their defense, it is the DA's first budget speech ever, so they're still learning. But when the budget first came out, there was $260 billion worth of additional expenditure. That hasn't changed. All that happened was they just fiddled with some of the denominators. We're still spending as much as we planned. So the GNU, although we're fighting over the budget and we may not even have a budget tomorrow, they're not trying to cut spending, which is what they should be doing. They've been fighting about how to raise taxes, which I think is a pointless task because we can't afford any taxes, whatever it is. And again, as Professor Arun pointed out in Signals last month, and if you look out for our Q&A Zoom session that we're putting out, that Arun and I had together to talk about that, the best possible way of increasing taxes is VAT. Not only is VAT pro-poor, it's also pro-household wealth, and it's pro-growth. So we've gone from the first budget to the modified one, and all that's happened is we've reduced the amount of VAT that's going up, and we've increased the amount of personal income tax. So what's going to happen? Well, we're really on the wrong side of the Laffer curve. People are just going to pay less tax, whether it's getting their partner to stop working and work from look after the family because it's cheaper to homeschool, or it's cheaper to just not employ any help. Or if it's immigrating because you're just tired of paying so much tax. We've seen the last time PIT, personal income tax levels were raised, the amount of tax that was raised fell. So yes, it's fine. Don't adjust the inflation. Don't adjust the inflation brackets for PIT over the next 4 years. Collect 114 extra billion rand. Nice to put in your budget, but it's not going to happen. That tax is not going to be raised because people are going to avoid paying tax. Growth is going to fall, tax is going to fall, and basically we've got a far worse budget past the GNU's influence than we had before. What we should have been doing, the GNU should have been doing, is focusing on either getting better efficiency of spend, improving law enforcement, or trying to cut that spend, and getting presidential buy-in to not be spending where we don't need to spend. Anyway, bottom line is it's just the most depressing budget I've seen, because we've got very, very, very professional people who know what to do, who basically saying it's out of their control. And that's just depressing. So we do need to pray, unfortunately, for reforms. The new regulations that are coming out on the 1st of June, the private-public partnerships, are certainly a step in the right direction for reform. So hopefully that will lead to some spending efficiencies. And yes, another bright thing that, one of the good points that came out of the SOEs is that no more spend is being given to SOEs. One of the reasons government debt went up so much over the last decade was bailing out Eskom, bailing out Transnet, bailing out SABC, bailing out SAA, bailing out all these SOEs has cost us a fortune in debt. And that's why we're spending 22 cents on the rand for interest. So at least there was no more spend on SOEs. So that's one step that we can hope for. But unfortunately, it's too late. We've already spent too much on SOEs. So yes, National Treasury, well done. Thank you for not spending any more on SOEs going forward. But we're stuck with a mass amount of debt. And the only way we're going to get out of it is to cut spending or grow. I mean, certainly we could grow out of debt, but how do we grow? Maybe private-public partnerships will work. Maybe we can get the ports fixed. Right now, it looks like the DA have managed to miraculously, and well done to the DA, they've managed to hopefully get Cape Town's port included in Transnet privatization plans, as they had already included all the other ports. Why was Cape Town excluded? I don't know. Hopefully Cape Town's in, but right now, Cape Town is one of the worst ports in the world when it comes to turnaround times, and that's having a massive negative impact on the Western Cape economy. So, there are some easy fixes, but we still need to see them happen. So maybe, the GNU's only been in power for a year, and maybe it takes a while for these things to happen, and maybe, maybe we'll start to see some improvements over the next year. So far, all we've seen is Eskom. And that was mostly because of the private sector getting involved. So when it comes to South Africa, we were underweight SA bonds. We were neutral SA equities. We've now gone underweight South African equities because South African equities have performed incredibly well. Goldman Sachs has downgraded SA equities from overweight to neutral, and we've seen all three pillars, all three sectors of SA equities do very well. Firstly, from when the GNU was announced until now, because of load shedding ending, because of the GNU, we've seen SA Inc., banks, retailers, all re-rate by 30%. Then we had the Chinese tech rally at the end of last year, beginning of this year. We've now seen Naspers and process rally 30%, so that's pushed our industrials up. And now most recently, we've had resources rally 30% because of commodity prices. So all three sectors have simultaneously done very well, which has been fantastic, and it's wonderful, and it's driven all our equity returns up, but it leaves limited room for further South African equity growth. Whereas emerging markets, India is looking quite cheap, China is very well positioned. Yes, EMs do have to worry about reciprocal tariffs, but unfortunately, so does South Africa. We have managed to get ourselves into Trump spotlight. We've lost all our aid, our healthcare aid. Looks like we're losing all our military aid from the US, and that's another risk to our budget. And in terms of spending, is the budget this year, although it is horrific, the risks are firstly that it hasn't put in any funds for the loss of US aid, and secondly, the COVID grant, even though COVID is long gone, the COVID grant's only in the 3-year forecast for 1 year. So if it has to be added in for the next 2 years, that's an extra 35 billion rand a year. That's 70 billion rand. That means that's got to go up another 2% just to fund that alone. So there are big risks when it comes to the budget. So yeah, this is probably the most negative I've been on South Africa for quite some time. And it's one of the reasons why we have gone underweight SA equities. We're more comfortable with emerging markets because things are changing there, particularly in China. So hence that change, but rather depressing, I must say. Okay, let's look at our overall positioning, and then I do have a slide on the living annuity plus funds. So don't disappear after the outlook. Hold on for that last slide. Okay, so tomorrow, as I've said, is Liberation Day. Just such a fantastic marketing spin to having to pay more for things. So if you look at the charts on the right, this is from JP Morgan, and this came out before Trump announced the 25% automotive tariffs, which could be quite substantial. But without that, you can see how in February we had the 10% China tariffs. So that pushed up, that's 3.9 there. So that was that pushed up US average import tariffs to 3.9%. Then in March, we had 20% tariffs on China, plus 25% on non-USMCA compliant Mexican and Canadian goods, plus, which was also 10% Canadian energy. That pushed us up to 7.1. And then reciprocal tariffs could push us up to 11% tomorrow. So we'll find out exactly what that has in place. Those tariffs are pretty big. And then we also have to see what, Canada and Europe and Mexico put on in return, and that will then could lead to further escalation. So we are, while we aren't forecasting a recession as a base case, things could escalate quite dramatically, and we'll find out exactly what happens tomorrow. But the interesting thing is that Trump's trade policies are spurring fiscal expansion in the rest of the world, China being the best example, but Europe or Germany following closely behind, and also galvanizing voters. And we're seeing that across the world, leaders have seen an increase in their approval ratings, from Sheinbaum in Mexico to Carney in Canada. I mean, and that switch in Canada has been absolutely incredible, all based on anti-Trump sentiment. Macron has seen an increase in his approval rating. Zelensky, despite what happened in the Oval Office, has seen an approval of his rating. So across the world, as people start to see Trump as the common enemy, which is ironic, everyone is supporting their leaders. And we're seeing approval in their ratings. And it doesn't mean that all those leaders are treating Trump in the same way. As I said, some European countries are pro-Trump, whereas others are anti-Trump. So it's not all going in the same direction. But whether those policies can actually counter tariffs, or whether it's in the US, lower tax rates and deregulation, or whether it's in Germany with the infrastructure fund, or China with their high budget deficit, needs to be seen, and all depends on exactly how these tariffs roll out, and we just don't know. So that's why we are cautious and we are neutral equities, but we haven't gone underweight just yet. Some of the other positive news items that came out in the month was OPEC. OPEC has decided to restart production. Basically, they've given up. They've cut oil production for the last over 2 years, by nearly 2 million barrels a day. They're saying, well, we couldn't really get the price to go up when we were cutting production, so let's just increase volumes and at least make some money through volumes, if not through higher prices. So that's great for inflation, because Chinese oil consumption is still falling as their shift to electric vehicles is way ahead of schedule. American supply of oil keeps ramping up. Overall inflation from an energy perspective should stay muted, which is good for easy monetary policy. Then an interesting data point, we have made a small switch. One of the ways that we reduced our exposure to equities to go down to neutral was we bought high yield credit in the US. And that's giving a decent expected return over the next 12 months relative to US equities, certainly a more stable return. So that is, we've made our first nibble at that. We may increase it going forward as markets recover, and we do think there will be some recovery as US growth works through these headwinds of the gold imports and the cold winter and some of the Q4 imports that were ahead of the tariffs. Then an important one is our view on the dollar. The fair value of the dollar is about 110 to the euro. Now we're currently sitting at 108. So the fair value says, and this is based on 2-year bond interest rate differentials. We could see a bit of strength sorry, a bit more weakness of the dollar, but we're more likely to see strength as the US growth starts to recover and as these tariffs are put in. So we think dollar is likely to strengthen from these levels, which is, means the rand could weaken further. As I said, Goldman Sachs has cut SA equities. We prefer emerging markets, broader emerging markets. And finally, we saw the most recent number out of US S&P Global March PMIs, which rose above expectations. So growth is still holding up around the world, 53.5 above expectations. So right now, yes, we have risks. Risks are rising to maybe 30, maybe even 40% of recession. But the on the ground numbers when it comes to economic growth are still stable. And those forecast recession numbers are very much focused on the consumer, whereas businesses and markets are less concerned about a recession. So we'll be, but we'll be watching tomorrow's news items. We'll be watching Liberation Day very, very, very closely, both on the SA budget and on the reciprocal tariffs, to see exactly how much our wallets are liberated and how much US wallets are liberated. Okay, final quick slide before we move on to Q&A. Today, we are launching the Living Annuity Plus Fund. So that's for Signia living annuity investors who want to invest into funds to increase their global exposure above 40%. So important points, if we follow that asterisk down to the bottom left of the screen, you'll see that all our current global funds, so if you are a living annuity investor and you're sitting at a 40% cap to global, and you've got FANG and Fourth Industrial Revolution and Berkshire Hathaway, those unfortunately are still capped at 40%. So you can't increase Berkshire Hathaway by more. But you can get exposure to these two funds up to 80%. So one thing you could do if you are invested in one of our broad equity funds, you could switch out of that into the Signia Life MSCI World Plus Fund, because that's giving you broad equity exposure, and it doesn't use, it's not subject to that 40% cap. So you could restructure it quite cleverly if you want to then use some of that capacity, which you free up to put into a FANG fund or a healthcare fund. So there are some interesting things you can do. But all the thematic funds are still capped at 40%. So launching two funds managed by Stephen, our head of indexation, and Mish, one of our portfolio managers. The Signia Life Dollar Cash Fund, that gives you, or tries to beat dollar cash returns. And the Signia Life MSCI World Plus Fund, which tries to beat the MSCI World Index Fund, or the index. How does it try and beat it? Well, it uses a concept called portable alpha. Basically, it invests in money market funds and uses the very small pickup in that interest rate differential to add to your index return, so that you are getting index plus, and it should outperform passive funds, or at the very least cover the fees of tracking that index and give you a slightly positive alpha on those portfolios. So very exciting funds. It's our first portable alpha funds that we are launching, and the marketing sheets will be available on our website this afternoon. So please have a look for that, and we'll also be sending out a mailer quite soon. So very exciting news for living annuity investors. Then the other thing I mustn't forget to announce, I will give you some time to try and grab a quick lunch after my Q&A, but we have a Bravos webinar at 1 o'clock today, hosted by our CEO, Magda. So if there are any questions, please dial in for that Bravos webinar at 1 o'clock today. Okay, let's have a look at the Q&A when I can find the Zoom bar. Okay, great. Okay, I have a question from Vilakazi on the bond layering fund. Vilakazi, we don't do any duration bond methods. So our enhanced bond fund is duration neutral, and we overlay credit onto that fund, which is pretty similar to our portable alpha funds that I've just spoken about on the living annuity side. It's about credit enhancement on an index. You know, when it comes to bond, if you're talking about bond laddering, that is a tool that can be used to try and roll your bond duration, but we don't offer anything like that from any of our funds. Then a question, which I think I've just answered, Signia Life Plus funds will be launched today. They are live as of the 1st of April, not an April Fool's joke. Those funds have gone live today, so please look out for them. And the further follow-up question is, will we be allowed to transfer to the life funds, or is it only switches? Yes, you can put new money into those life funds, and you can switch money into those funds. So those funds are open for new flows and switches. Stuart says the Signia Life Berkshire Hathaway fund is looking great. Can you purchase that through an RA TFSA direct? Stuart, you certainly can purchase that through an endowment on our platform, or in a living annuity, or an RA. So it is available on our platform for investors to invest in. And as I said, while it is capped at 40% on direct investment through an endowment sinking fund and 40% on a living annuity, you can switch some of your money into these new funds to top up your Berkshire Hathaway if you want to. There's a question, Carl, do you see an uptick in SA markets in the next quarter, despite all the political uncertainty and trade wars? Nope. As I've said, I'm a little bit more pessimistic about SA than I used to be. Also, what are your views regarding US markets and how a strong US economy strengthens Signia's position in terms of international exposure? It's a good point. So we are going over global because we're concerned about South Africa. That said, you know, there are opposing forces that are driving EM right now. Generally, tariffs are bad for EM. And you saw what happened in the trade wars of 2018, Trump 1.0 trade wars. It was bad for emerging markets. But this time around, you know, we've got some positive factors. We've got India, which is already priced in a lot of bad news. From China, you've got a lot of stimulus that should support its economy, regardless of what happens with tariffs. And in Korea and Taiwan, some good tech exposure, which should be relatively resilient over the next medium term. So less pessimistic on EMs than there would be given tariffs. It's also quite interesting to see, you know, how Trump is playing this time around. Trump 1.0, his tariffs are all about emerging markets. But I think his advisors have realized there's more pass-through inflation to the US consumer through EMs than there is from Canada and Mexico. Well, maybe I should just say through China. So that's why we're seeing a lot more focus on we're seeing a lot more focus on Canada and Mexico this time around than we are on China and Taiwan and Korea, because Trump's trying to limit the inflation impacts that we're seeing. So, you know, certainly things are a bit different this time, and I think probably a little bit more positive to EMs than they were the first time around. That said, tariffs are bad for South Africa and EMs in general. Andrew says, based on your comments to the positives around the US economy, is there likely to be a bounce in S&P 500? Andrew, it all depends on what we see tomorrow out of the US. Our base case is certainly that we see a bounce in the US. If there's no recession, if, you know, we see an unwind, if GDP recovers from the 4Q distortions, from the import distortions, from the weather distortions, if immigration is not aggressively changed, and tariffs are reasonable, then I think the S&P will definitely bounce. Of course, if we see incredibly unreasonable tariffs being put through tomorrow, well, then the whole world could go into recession. So our decision tree from this point is not so much chasing Europe. We've already bought some more emerging markets. It's not so much chasing Europe. We do because if things get really bad, Europe's going to fall along with the US. So it's either tariffs are acceptable, in which case the US will probably bounce more, and so we'll stick to our US position, or tariffs are terrible and everything tanks and we sell equities, go underweight equities, and we buy probably cash and probably dollar cash, because even though it's US tariffs, the dollar is still the safe haven of the world. Even though it's less the safe haven, it's still the only safe haven. Romano says, are you worried about the US Treasury's military expansion plans, considering that the machines will now be more involved in the manufacturing of the weapons? Sorry, I'm not quite sure I understand the question. All I can say is certainly defense stocks in the US have rallied very strongly, as have defense stocks in Europe. And there certainly will be support to US GDP growth and European GDP growth from continued military spend. It also all depends on exactly how the Russia-Ukraine war turns out. I think Trump thought he had everything cleverly planned. And while he has been very successful in spreading the defense spend, so getting Europe to meet their NATO targets or even exceed their NATO targets, Putin, I think, is not playing according to Trump's playbook. And so we're likely to see that take a lot longer than expected to get a ceasefire in Russia and Ukraine, which means that defense spending is probably going to continue. Mr. Nike says, could falling productivity be linked to the surge in immigration in Europe in general and Germany in particular, especially Merkel's years as chancellors in the last 20 to 25 years? Certainly. The immigration hasn't actually been as bad for Germany as it has, as people feel it has, but generally immigration is good for growth. Whether it's legal immigration or illegal immigration, it's helped. So reducing immigration, and I don't think immigration is going to be welcomed any faster in Europe, is a headwind to growth. So going forward, people are going to be more anti-immigration, just as Trump is. In Europe, that's why we are seeing some far left and far right moves when it comes to voting. And that decrease in immigration is going to make GDP headwinds even worse than the productivity falls that we've seen. So yeah, I think immigration is a headwind to growth everywhere. Sean says, re-German productivity, quite surprising. Surely tech adoption has advanced, should have mopped up falling productivity. Graph seems surprising, and less also influenced by lesser productivity, less productive migrants. Sean, it's a good point. I'm not sure exactly why productivity has fallen so much in Europe. As I said, one of the big things has been an aging population. I haven't seen any impact on the influence of immigration on productivity per se. On inflation, yes. On growth overall, yes. But on productivity, I don't know if there's a link between immigration and productivity. I think what Germany has struggled against is it's always been a powerhouse of manufacturing. That is Germany's bedrock of its industrial productivity, efficiency, and they were always their leadership was unquestioned, and China has moved into their space. China has gone from low quality manufacturing to high quality manufacturing, and Germany's lost a lot of market share to that. And I think that those market share losses have certainly reduced Germany's growth, and that's fed through into productivity. But maybe it's been, sorry, I'm thinking on the cuff here, but maybe it's also been Europe in general, but Germany in particular, very, very strong labor laws. Labor laws, very bad for productivity. So maybe it's just been the increase in unit labor cost in Germany relative to US labor cost, relative to Chinese labor cost, unit labor costs, which has led to higher or falling productivity. In fact, I think that's probably it. It's probably very strong unions, which we've seen rising unit labor costs and falling productivity. And those unions are not going to go away in Europe anytime soon. So that's unless we see some very strong structural changes, but I can't see that happening. I was definitely wrong about changing the constitution, about taking on more debt, but the labor unions are very strong, and I don't see that happening anytime soon. Just like I don't see South Africa cutting our spend because our president's reliant on labor unions for votes. And it's why we're not getting the spending cuts that we need, the inefficient spending cuts that we need in some of these departments like education and health, to cut the unnecessary fat, because then the unions will complain. Okay, sorry, catching my breath. Johan says, see, you took some water before getting to South Africa. I guess we all need that. Yes, Johan, unfortunately, we do. We all need to turn on our solar panels and our boreholes and get a fresh glass of water just to deal with some of the disappointment in South Africa. Sean says, South Africa Finance Minister, how, if they know what needs to be done, can they allow government to ruthlessly waste money? Why are they toothless? Why does big business not tackle them head on, read tax revolt? Their hand needs to be forced, as they're obviously uncaring or of consumer agony. So, Sean, as I've just said, I think it all comes down to political will. It is President Ramaphosa's second and final term, hopefully like Trump. So in theory, he should be able to take a harder stance against the unions and make some of the tough decisions that need to be made to drive job growth and to drive economic growth, to make things better. But I think, given the ANC's huge losses in voting share, that he's terrified of the unions turning away from the ANC and seeing even further ANC losses under his leadership. So I don't think there's a political will. And I think what's worse is, and I don't know how this is linked, but the fact that the head of BLSA says that state capture is alive and well means that we have to keep spending these vast sums just because the corrupt need the spend. And until we have law enforcement fixed, until there's more people penalized and made examples of, well, there's not going to be much change. So yeah, I don't know what the answer is, but we do have a problem. Well, I suppose the answer that everyone's hoping for is better growth through private sector involvement. And why? Because the private sector can more closely monitor the projects that they're involved in to reduce corruption and reduce state capture. So the more we move new developments and new projects away from being 100% government owned to being partnered, so that we can have better law enforcement and better accountability, the more we'll have growth, job creation, and the better return we'll get on that spend. So that's our hope. Our hope is that the private sector can drive accountability through these partnerships. It has certainly happened to some extent through Eskom. We haven't seen anything yet through Transnet, even though there are promises. But we need to see a lot more of it. We need to see these, and so hopefully these regulations that come through on 1 June will allow more of it. But we definitely need to see, a return on investment from our SOEs. And not only that, but the wage bill that we spend when it comes to some apparently some of these department heads in the healthcare department and other various government departments. You've got 4 department heads all doing the same thing, all sitting on 4 million rand salaries. I mean, that's just ludicrous. So it's not necessarily the nurses and the teachers who are overpaid. I think the opposite is the fact. I think the nurses and teachers on the ground are underpaid, but you've got this middle tier that have somehow sprung up and morphed, doing very little and getting paid exorbitant salaries. But to restructure that needs political will. And then on the other hand, you've got corruption, and that needs to be changed through law enforcement. So, which also is political will. So, yeah, we've all been talking about reforms since Cyril 17. It's now Cyril 2025. We're seeing some changes since the GNU, and hopefully things will accelerate. But yeah, we're not putting our money in South African equities until we see more evidence that acceleration is actually happening. Yeah, a question to Anonymous. I'm not sure exactly what the GNU is asking. As you know, the Rand weakened rapidly on Friday when the DA said they were pulling out, and then strengthened yesterday when the DA said that the deal is nearly done. I don't know what the deals are, but I don't think that the GNU is fighting over VAT. If anything, they're still trying to reduce VAT, not increase VAT. Anonymous, I'm not going to repeat what you've said, but yes, things are unpleasant for South African citizens. And we need to hope for reforms. Rian, is now a good time to invest in the S&P 500? So, Rian, difficult question. Tomorrow we'll find out exactly what the Liberation Day reveals. But as I said, on a 10-year view, South Africa S&P is definitely the best place to invest. Maybe now after tech has derated and you're sitting on 26 PE, maybe S&P is still good and still the best place to be on a 3-year view. We have reduced our overweight to the US. We are still overweight, but underweight tech. So we're able to take a nuanced view. That's a bit more difficult than just buying the S&P 500. But it's definitely a lot cheaper than it was, and I think definitely overdone. But whether it bounces along, whether we get an L-shaped recovery for 6 months, or whether we start to trickle up in a U-shaped recovery or a V-shaped recovery, I'm not too sure. That all depends on tariffs. Nick says, Carl, please forward this presentation to the powers that be in government, parliament, and at Luthuli House. Nick, I can promise you that there are very, very, our chair of the Signia Investment Committee, Professor Haroon Borat, sits on the President's Advisory Council. Everything that I've said today, he believes in and goes to the President. Everything that I've said today is nothing that the National Treasury and the Finance Minister haven't said. It all gets fed back. It's just the political will, once it gets to government, for these things to happen. So forwarding the presentation is unfortunately not gonna help. Sean says, where do we get the link to the webinar this afternoon with Magda? Sean, that is a very good question. We've got half an hour, and I'm actually not sure how people who have invested in OSE would have got an email 2 or 3 weeks ago with the invite. But if you email admin@signia.co now, hopefully you get a response within the next half an hour, and they'll send you that link. Otherwise, the webinar will definitely be on our YouTube site shortly, and you'll be able to obviously watch exactly what Magda has to say about Bravos and OSE, Oxford Sciences Enterprise. But hopefully you get a link and you can join and ask questions. So I see the next 4 questions are all asking the same thing. I hope that admin@signia.co.za responds accordingly. I will certainly follow up with them after this call. Peter says, are the 2 new funds, the 4 life funds, that's a great question. They are living annuity plus funds. They're for living annuity investors. It's not, it's very separate to Signia for Life, which is a different product altogether. For Life is a post-retirement product, but it's, for Life goes into, it's a life-staging product that goes over time into a fixed annuity. This is for living annuities, and it's for living annuities to switch money into these products. So if you have any living annuity with a flexibility, you can switch. Thanks, Daniel. And Mark, same point on Magda. I hope you can get it. Sean says, has Signia considered introducing Tontinus? I don't know if I'm pronouncing it correctly, for retirees. If not, please investigate and provide feedback, as there's very little innovation in retail product development in South Africa. Is this on the bond laddering? Okay, Sean, noted. Okay, we'll certainly look into that as a possible product. Anonymous says, are you worried about negative returns for FANG portfolio year to date? Anonymous, we've been underweight US tech because we are worried about those three big risks that I mentioned. It's definitely cheaper than it was after the derating we've seen. And the companies they definitely have the best moats out of any company in the world. But I think those headwinds are going to remain for us for a while. So it all depends on your time frame. If you've got a long-term time frame, well, I think you'll still do well out of those funds. But if you're sitting in cash, I think you can also afford to wait a little bit longer before buying. I think that's I think that's what keeps the price pressure on these shares, is that not that they're bad companies, but people are sitting on the sideline waiting for either a catalyst to change or a trend to change. So it's 12:30. A few more questions that I'll rush through. Serena says, have you reviewed your outlook on enhanced bonds? Serena, no, we're still underweight South African bonds. South African bonds, as you saw, over the last year, giving you 22% in our enhanced bond. Phenomenal performance. I don't think there's any easy money to be made out of South African bonds going forward. Easy money would require either US bond yields to fall, which we're not seeing because we're in a higher for longer inflation environment in the US, or the rand strengthening to lead to our bond yields falling, and that's not going to happen. Or some structural reforms, which leads to the term structure and yield curve flattening, which I also don't see. So, we think that we're probably going to get better returns out of enhanced income over the next year than enhanced bonds. Currently, the yield is higher on enhanced income than enhanced bonds, and there's a lot lower volatility. That's our preference. Johan says, is AGOA being affected by tariffs now in the future? AGOA is in place until September. Right now, if things stay as they are with the US, we won't see AGOA being refinanced in September, which would be a headwind to SA growth, unfortunately. Hopefully I've answered your question on FANG and S&P. Long term, great place to be. Short term, I wouldn't be buying just yet. Donna, hopefully we'll get that link to you. I'll also look into the bond laddering. Andre says, why is a 40% cap applied to Signia Global Unit Trust funds and not ETF funds? So Andre, that's very important. So Signia Unit Trusts are not capped for discretionary investments. So if you are using your discretionary money, whether you're buying an ETF or a Signia Fourth Industrial Unit Trust, there's no cap. So retail investors are not capped. The cap sits at the Signia level. Signia is capped by regulation. We can't have 40% of our management company offshore. So, and that's about our mix. So that's why endowments, whether if you're sitting in a direct endowment, a sinking fund, or an endowment on Signia's platform, you're capped whether you use that endowment to invest in a unit trust or an ETF. So it's not that unit trusts are capped. Nothing's capped if you're a discretionary investor. Everything's capped if you're a living annuity investor or an endowment sinking fund investor, except for the two new LA funds. Peter, thank you for your thank you. Johan, I see SA interest rates not being able to cut as much as we need, which again is good for enhanced income over the next year relative to enhanced bonds. Bronwyn says, Carl, do you think the increase of personal income tax is the government's way of trying to recoup a large percentage of some of the additional spend on government salary increases? Definitely. This is the only way they can do this without upsetting the political landscape. Definitely. So that's what we've seen is we shouldn't have had 233 billion rand extra spend since the 6 months ago budget. Just can't afford it. The best way to try and afford it was VAT. And unfortunately, that's now changed to PIT, and that's going to be a problem because we're not going to actually see that come through. It's going to destroy growth. It's going to destroy tax revenues. It's going to increase inequality more than even VAT would, and it's a problem. But for some reason, the GNU thinks that PIT is more politically acceptable, whereas the most politically acceptable thing when it comes to driving inclusive growth. If you want to drive inclusive growth, the best thing you can do is VAT if you have to raise revenue, but the best thing you can do is actually law enforcement and more spending cuts. Alan says, I'm an emerging markets ITRIX ETF in my LA switch to new fund. Alex, that's an investment decision, which you shouldn't be driven by regulation. So, the new LA fund is an MSCI World Fund, which is a developed market fund. So you need to be comfortable about switching from emerging markets into developed markets. If you have, I'm sure you're not 40% in emerging markets, you probably have some DM in your LA, and then you can do a investment neutral switch into the new fund. But I wouldn't, unless you're comfortable moving more into EMs, I wouldn't do that. That said, we have just switched a small amount of our US exposure into EMs because we do, as I said, that growth convergence has happened slightly, particularly in emerging markets related to US. Pleasure, thank you for your thanks. Pleasure, thank you. And that's it. Sorry for going over time. Thank you so much for your questions. Thank you for joining me. I really appreciate your time. I really appreciate you joining and listening. Yeah, let's see what happens tomorrow in Liberation Day. And then I had a Q&A, as I mentioned, which we recorded in the KFM studios with Professor Huan Borat on the budget. That should be available soon. And then also we're going to be doing another Q&A session with my co-head of investments, Ian Anderson, who is Canadian. And we'll be getting, post-Liberation Day, we'll be having a specific tariff, and specifically Canadian tariff Q&A session, just trying to work out exactly why, what, and how these tariffs are doing that. So you don't have to wait for the next webinar in a month. There will be something shorter, a very short thing that we'll release onto our YouTube platform about tariffs. So please keep an eye out on our YouTube platform. Great. Okay, have fantastic school holidays, everybody. Hope you enjoy the break, and I'll see you all next month.